So far what we have understood is on basics of derivatives, terms used or the concepts required to understand derivatives. But so far we have not yet entered to the league of derivatives. So we are going now. Mainly we have three areas to understand in this chapter. That is forward contracts, and then we have future contracts, and then we have options. Whereas in forward and futures, there are many common points and there are some small differences. In fact, many times it is used interchangeably as well, and therefore we will discuss forward and future together now, and later in the stage we'll talk about options and options in details. So forwards and future, there are many common points. Let me discuss one by one. So let's first talk about forwards and futures. Forwards and futures. Now, what is common point? Let's discuss. What is common to both? So let me write few common areas, or let's say similarities, and let me talk about few differences. Okay. Now, what are similar points? Forwards and futures. Listen to me. This is an agreement entered today. Agreement entered today. You sign a contract. You're signing an agreement today to purchase or sell, an asset, to purchase or sell an asset at a later date, at a later date, at a fixed price, at a later date, at a predetermined price, predetermined price. So we are signing a contract today. Today we are only agreeing that I'm going to purchase the share later at a particular price. So two things are fixed. One is at a later date. This is called as settlement date or called as expiry dates. This is the settlement date. And predetermined price, this is called as the forward price or called as future price. Forward price or called as future price. So if one person is entering into agreement to buy, for other person it is automatically agreement into sell. So date of sign is one date and date of settlement is another date, and the price at which you are going to pay is also decided in advance. Example I'll give you, don't take it wrongly. A quick example you can understand maybe. I told you this contract are like engagement. So engagement is also agreement entered today for transaction at a later date, marriage date, at a price. You know what you mean by that, which is decided in advance. So futures and forwards also, it is entered today for settlement at a later date. So quickly, I'll give you some practical ideas. Hopefully, you'll understand better. Okay, what is the difference also? Parallel, I'll tell you. The difference is because future has some standardizations. Future has got standardization. Why? Because forward contract is a over-the-counter contract written between two parties, whereas future is traded in stock market. Forwards are not traded. That is between two people. Futures are traded. Futures are traded in market. You will have a future segment and that will have a separate price and separate transaction, separate brokerage and so on. What are the standardization? One example I'll give you. Many are there. One example I'll give you. One is standard expiry dates. Standard expiry dates. I'll give an example. See if you are able to understand. Directly I'll go for the website. I'll go to, let's say, NSE India. I just click on this old website so that I can show you better. In new website also good, but old website I can just show you easily. So to make you understand the difference between spot market and future market. Let's say I'll take something like Tata Motors. Tata Motors. In NSE website, I'm looking at it. Hope you are able to see it. What is the price? Tata Motors 478.5. This is called as spot price. Means what is a spot market feature? You make a payment of 478.5, you get one share of Tata Motors today. Of course, operationally you will not get immediately. You will have to wait for 2 days, T plus 2 days. But theoretically, conceptually, you can think it is cash and carry segment, spot market. You can make a payment of 478.5 and you get the one share of Tata Motors today. Fine. Okay, this is spot segment. You see, next we have equity derivative segment. It's a separate market by itself. And there I'll select Tata Motors. Remember, spot market was 478.5. Why it's not showing? Okay, we got it. Equity derivative we require. Okay, it's not showing. Let me just go for let's say Tata Chemicals. It's 904. It's spot market. In derivatives, okay, maybe because not a working hours, so it's not showing because of that. So I'll do one thing. I'll see if I can have in BSC derivatives. Okay, BSC is not so easy. Let me do one thing. Let's say Tata Motors future price. Okay, so I've gone to moneycontrol.com. You can see that Tata Motors is having a price of 479. It was 478.7 something, that is in spot market. So in future market we have 479. You can see this is a future price. And what is the expiry date? Please take a look at this. Expiry dates 30th December 2021. Hope you are able to get it, or you hope you are able to follow it. What do you mean by this? Today I am signing a contract to purchase Tata Motors at 479 on 30th of December 2021. I am not purchasing today. I am going to purchase. I am signing a contract. I am entering into an agreement. When I say enter into future, it means I enter into an agreement. And when it's going to be settled in forwards, it decides between two parties. It's an agreement, over the counter agreement. But in stock market, those expiry dates are standard expiry dates. And in India, we have 1 month contract executing, 2 months contract, and 3 months contracts. So we have 30th December 2021 is the expiry date. Why not 31st December? Because in India, we follow last working Thursday. Last working Thursday. Therefore, 30th December 2021 is the last working Thursday of this month. And we can enter into next month, and as well we can enter into next month as well. Okay, see, just show you zero the margin calculator maybe. I'll tell you what is margin also. But let me show you practically directly. Okay, so I'm selecting futures. So I'll go for, let's say, Tata Motors. Yes, you can see three dates: 30th December 2021, 27th Jan 2022, 24th Feb 2022. Can you see the three dates? That is what I'm telling you. At any period in time in futures, it's a standard instrument. You cannot enter into any date you want. You can enter, but the expiry dates are fixed expiry dates. So on 30th December 2021 or 27 Jan or Feb. At a present, we have 1 month expiry, 2 month expiry, 3 month expiry. That is what is a practice allowed in India. And quantity, this is one more point you have to understand. It is lot size. Lot size, this is a not concept not there in forward contract. This concept is there only in futures, meaning you cannot buy how many ever shares you want. One lot, two lot, I mean one share, two share, you can't do one lot. See, one lot means 2850. This Tata Motors, let me select Tata Chemicals for you. One quantity, what is a quantity? One lot is 1000. And if I select Reliance, one lot is 250. Infosys, one lot is 300. HDFC Bank, one lot is 550. Hope you are able to observe this fact that you have a lot size concept where you cannot enter into any number of units you want in future. In forwards you can, but in futures you have to enter into a standard number of units. If lot is 300, so you can buy 300 lots, I mean 300 shares, 600 shares, 900 shares, and so on. But 3 one not one share, 5 shares, 10 shares, that is not possible in future segment. Okay, now what was the number we talked about? Tata Motors has got 479, right? Now, what is the amount required? Okay, now coming back to Tata Motors, 30th December 2021, 2850. Can you tell me, if you want to purchase 2850 in spot market, how much does it cost you? 2850 into 478, let's say. I mean, so you can think, sir, spot market also 478, I'm sorry, 478. In future also 479. Only 1 rupee difference, hardly any difference. I'll go to spot market only. Why should I go to future market? There lies an idea. I'm showing it to you. Please take a look at this. In spot market, if it is 478 rupees into 2850, you have to pay in full amounts. How much? Let me calculate quickly. You can also calculate. 478 rupees. 478 rupees into what was the lot size? 2850. 2850. You need 13 lakh 62,300. For one lot, you need 13 lakh 62,300 in cash market. But in future market, you don't have to pay full. What you have to pay? You see, I'm showing it to you in Zerodha. How much you have to pay? Okay, the website is slow. Okay, this time it is not showing. Okay, maybe we'll have to check it out later. Okay, anyway, what I'm trying to tell you is 13 lakh something required, right? In a spot market. In future market, you don't have to pay full 13 lakh. Maybe you have to pay 3 lakh, 4 lakh. That's called as margin. That's called as deposit. We have types of margin: initial margin, variation margin, and we have call margin or call money, maintenance margin. We'll come to it, all those things. But in forwards, it is a contract between two people. There is no features like lot size, standard expiry date, margin. These things come only in futures. So let me go back. Maybe this is not a working time. That's why it's not showing. Maybe we'll try a little bit later. We should be able to see it. Okay, let me go back. So what are the features that we have learned extra in futures, applicable only for futures? We have things like standard expiry date. That one point we already identified. Standard expiry date. Then we had a concept of lot size. Lot, you have to purchase or sell in those multiples. That is there only in futures. Then you are having margin. Margin is like deposit. You deposit the money today and you get it back when you exit the contracts. It's a safety amount, basically, margin, initial margin. So when you enter into a contract, why future market is preferred over spot market? Because in spot market, you have to pay the full amount. Whereas in future market, you don't have to pay the full amount. A portion of it, maybe 25% or 20%, 1/5 of it or 1/10 of it. In developed countries and all, it's even more less, maybe 1/5 of it. Only that much money you have to deposit. It's not even cost, it's deposit, and when you exit, the deposit will be given back to you. That's why it's called as future is called as leverage product. Yes, it is having a higher profit because you're investing less. It can also have a higher returns. Higher profit, but higher risk also definitely exist. Okay, so these are the basic point I would like to talk about forwards and future. I'm going to talk about one or two special points which you have to understand from solving problem point of view, but that's only operational, but you have to understand. But before that, if you have any questions related to this topic, forwards, future, the differences, similarities, get it clarified. Or you can also write down this chart quickly if you haven't written. Forwards and future, you will have similarities, you have differences. Similarities are it is agreement entered today for purchase or sale at a later date. Later date is called a settlement date or expiry date at a predetermined price called as forward price or future price. This is common point. So conceptually they are same. But execution wise, operation wise, future has got some extra features because futures are instrument traded in market. So what are the features we have discussed? It has got a standard expiry date, standard settlement date. In India, we follow current month, next month, subsequent, last Thursday of every month. And for index, Nifty and Bank Nifty, we have every Thursday, every weekly expiry also there. But stocks will be having a monthly expiry. Then we have a standard expiry date, lot size. That is a unique thing for futures. You have to buy or sell in multiple of those units. And margin is like deposit. It will be much lesser than as compared to spot segment. So write down this part. Let me know if you have any doubts. Okay. So no questions. So I'll go further. Now, regarding these differences, we have after this two important point features. I will say operational mechanism that you have to understand. Very important 2 points. Please observe. One is called as MTM, mark to market, mark to market, mark to market, and also understand as variation margin, variation margin. What do you mean by this? Now, you see, today we are on 3rd of December and settlement date is on 30th of December. So, if I enter a contract today, when I am going to exit? I will exit on 30th of December only, expiry date, settlement date. But, you know the beauty of MTM? On a day-to-day basis, your margin will be adjusted. The profit or loss will be credited immediately on a daily close price basis. For example, you entered at 200 rupees. Remember, you did not pay 200. You just paid only margin money, maybe 10 rupees, maybe 50 rupees. Okay. Now, next day, if this 200 becomes 201, it's really just notional profit for you because you get the money only when you exit on expiry date. But the beauty of a stock market, the beauty of future, it will not happen in forwards. That is, that 1 rupee notional amount will get added to your margin money. You would have deposited, let's say, 30 rupees. Now the margin will show 31 rupees in your account. Getting the point? That at the end of every day, on a close to close basis, if it is a profit, it will get added to the margin money. And if it is loss, that will get subtracted. That's called as MTM, also called as variation margin. So on a day-to-day basis, it's not notional profit, it will actually get adjusted in the form of margin adjustment. That's called as variation margin. And one more very important point is the concept of square off. Square off. This is applicable as net settlement basis or cash basis. See, if it is settled by delivery, a square off will not apply. Will not apply if settled by delivery. Will not apply if settled by delivery basis. Settled by delivery basis. What is settled by delivery basis? What is net settlement? I told you already. I hope you know this concept. Settled by delivery basis means you execute the agreement. You make the payment and you get the share or you get the underlying asset. But net settlement means the difference between agreement price and market price differential. If it is favorable, you get it. If it is unfavorable, you are going to make a payment. Hope that is clear to you. That is what is called as net settlement. Now, how we execute net settlement in futures, that is called as square off. Let me explain what is that square off means. Please try to listen. Today you entered into, for example, same example I will take it. What was the number? Some 478 rupees, like Tata Motors. So you signed future price today on 3rd December. When you entered 2021, Tata Motor price is 479. Now 479, are you paying it today? No, sir. When are you going to pay? You are going to pay on 30th of December 2021. You are going to pay 479. Agreement to buy at 479. On 30th of December, you make 479, you receive the money, you receive the shares. So what I'm doing on 3rd of December, I'm just locking the price. I am just freezing the price, buy price 479. So that on 30th of December, I can make a payment of 479, get the shares. That is settlement by delivery basis. Suppose I don't want settlement by delivery basis. I want settlement by net basis. So what I'm going to do? I'm going to do square off. What is this going to do square of? Listen to this. Earlier, I have entered into future buy at 479. You know what do I do for square of? I do future sell on, let's say, 30th December. If the price is trading at 482, at 479, I already have a future buy. I'm already having a position. That's called as position. I'm already having an open position at 479, where my buying price is freezed, but I want to settle on net basis, so I will go for square of. Now square of, what will I do? I will do opposite contracts. And what do you mean by opposite contract? Square of means I'm going for opposite future sell. So earlier I already have a future buy contract. Now I'll do future sell contract at 482, let's say. So future buy and future sell, they will set off with each other, and thereby the differential amount of profit will come to your account. And the square of means it is opposite contract. Opposite contract. Opposite contract. So that they will set off with each other. That's called as square of. And one more concept is there, that is called as early settlement, early execution. Early settlements. It's because of the previous two concepts, MTM and square of. So early settlement not there in forwards, it is there only in futures. What is that early settlement? You have entered on 3rd of December, it's going to be expired on 30th of December. But can I exit on 28th itself on net settlement basis? Can I square off on 20th December? The answer is yes. Why? Because earlier I have entered into future buy. Now what will I do? On 20th December, I will enter into future sell expiring on 30th of December. So future buy going to expire on 30th of December, future sell going to expire on 30th of December, both will set off. The net differential amount is fixed amount. Buy price also you know, sell price also you know. And you need not wait for expiry date for the profit. Why? Because of the concept of MTM, that money would have come to your account already. Anyway, so you should be aware of practical stuff. So I told you so much in detail. As far as solving problem is concerned, it is very simple concept. Means what? You buy, that is your buy price. You sell later, you square off, that is your sell price. Difference is your profit. Of course, on margin money, you would have lost opportunity cost, or you would have borrowed money, you would have paid interest. That's also going to be your expense. And of course, brokerage will be there. All those charges also may be considered. And what position you take? If you're expecting the market price to go up, you take long position. If you're expecting the market price to come down, you take short position. And what is the one more advantage of futures? Even index you can trade in futures, index futures. Why? Index, I told you, stock market index, Nifty, Sensex are notional portfolio. I cannot purchase Nifty, I cannot purchase Sensex, but I can purchase Nifty futures, because it can be settled on net basis. I don't have to deliver Nifty, I don't have to purchase Nifty, it can be settled on net basis. So advantage of future is I can even trade commodity futures. Oil you cannot purchase. Gold, silver you may not purchase. Copper, nickel you cannot purchase. But copper future, gold future, silver future you can purchase. As good as trading or buying in those instruments. So when you cannot trade in spot market directly, like index, like commodities, the future market will be a very good area. Ultimately, of course, future is a derivative. There has to be underlying asset. That's what is there to purchase or sell an underlying asset. Anyway, so this is the overview of the basics, of course. Then I'll give a numerical example. Then I have to talk about three areas: speculation, hedging, arbitrage. Then we can look at the other concepts. First of all, if you have any doubts in the foundation of this topic, forwards and future, please get it clarified. Okay, so let me go for the three areas now. I should also talk about other types of margin. I talked about initial margin, margin at the beginning, that's amount of deposit you will get back after maturity. I talked about maintenance variation margin. Variation margin means MTM, the differential amount, what comes to your account on daily basis. We also have maintenance margin, like a minimum bank balance that you have to maintain. So if you have keep on incurring loss, the margin balance keeps going down, and so if it goes below minimum, then you have to put the money from your pocket to maintain the balance. So that is called as maintenance margin, and we are putting the money back. It is not equal to maintenance. It should go back to in original amount, initial margin. So initial margin, it keeps coming down to maintenance margin. You'll get a call from your broker. That's called as call money, because your minimum balance is going below. You have to put the money now, and you have to put the money not to put it to maintenance margin. It has to come to original initial margin. So that's called as call money, maintenance margin. Just be aware of it. Okay, so let me talk about now. Three objectives are there. So let me talk about it. Three objectives, futures can be used for futures or forwards. It's used interchangeably, but main point is in futures square off can be done. Forwards no square off. So I mean settlement by delivery only. So we have three objective. One is speculation. Next we have arbitrage, and then we have using future for hedging purpose. For hedging purpose. Now speculation means you are having a position. What is the position? You are expecting the future market or price to go up. You need to take a position. So if your view is market price will go up, then tell me what position you have to take. Remember, we have discussed in the basics. If you are speculating, you are having a view that market price will go up, what position you have to take? You have to take long position, that is bullish position. And in future, what do you mean by long position? You are going to enter into future buy. You are enter into future buy today, and later on expiry date or any date later, it's going to be future sell. Means square of future sell later. And of course, if the price has increased, your view came right, you end up making profit, you would have sold at a higher price. If your view was wrong, market price has fallen, that means you are selling at a lower price, you end up making loss. And I repeat, when I say future buy, you don't make the full payment. It is only an agreement. And if it is no margin given in the problem, it is like free investment, no investment, zero investment. But your profit or loss will be sale price minus buy price. This is if you're doing speculation and your view is market price will go up. You can also have a view that market price will fall down. the market price will fall down, market price falling down, then you should take short position, you should take bearish view. And what do you mean by bearish view? You should take a position of future sell today, future sell today, and later you're going to do future buy, future buy later. And shorting was not easy for retail people. It was allowed only on intraday in spot market. If you want to go beyond intraday, then you have to do a stock lending mechanism, which is allowed only for institutions, not for retailers. But for retailers, you can do future sell. Oh, I'm worried about stock market falling, Nifty falling, coronavirus, omnivirus, coronavirus, Delta variant. Don't think, short the market, sell the futures. Later, it will come down, you buy. You can make a profit. You can make a profit when the market is going up, or you can make a profit when the market is coming down. So sell today, buy later. And you don't have to deliver the share. The question keeps on coming to your mind. How can I sell when I don't have it? This is not I'm selling. I'm entering into an agreement to sell. For signing an agreement, I don't have to have anything. But for me to execute later, I need it. At that time, I'll do square off. I'll do future buy. Thereby, if market has fallen as per my expectation, I'll buy at lower price. I make profit. If market price is increased against my expectation, I'll buy at higher price. I'll make loss. So ultimately, difference between buy price and sell price is my speculation profit. Okay. Now coming to arbitrage. Again, we discussed about the basics of arbitrage. Arbitrage means, that price is not equal. Price between what? Price between spot market and future market. So arbitrage, we have to compute something called as fair value. In arbitrage, you have to compute parity price. We have to compute fair value. So we have to compare two things. One is in spot market price, and we compare with future market price. Future market price. Now, can you tell me, can I compare these two data as it is? Can I compare spot market price and future market price? No, I cannot compare. Why is that? Because spot price is for today's settlement. You get the point? Spot price is for immediate settlement. Future price, I'm going to pay after 1 month. I'm going to pay after 2 months. I'm going to pay after 3 months. So there is a time value involved. And in future contract only I'm signing. I'm not making a payment. I'm going to make a payment at a later date. So what I can do, that much money, I'm going to make a payment. I can keep it somewhere, earn interest on that. Basically time value of money. So these two market prices are not directly comparable because of the time involved. So spot market price plus interest. Plus interest, I am telling you additive model. If it is compound interest, I do 1 plus R. If it is continuous compounding, I will do e power RT. Basics we discussed. Spot price plus interest should be equal to future price. Spot price plus interest. Spot price plus interest should be equal to future price. Should be equal to future price. This spot price plus interest is called as fair value of the future. So fair value should be equal to price. That's what we require. And one more small point. What if dividend is paid? What if dividend is paid? Now, do you remember we discussed in the basics corporate valuation, equity valuation, dividend chapter, on the date of dividend payment, what will happen to share price? The moment dividend is paid out, it is distribution of profits, distribution of net assets. In that case, the share price will fall and that share price after payment of dividend is called as ex dividend price, right? Therefore, after the date of execution, up to the date of settlement, between those two, if you are expecting any dividend, that should be subtracted. That is very important. So, interest you add, dividend should be subtracted. That is X dividend price. And sometimes dividend they'll give in percentages, dividend yield. In that case, interest also will be in percentages. Dividend also will be in percentages. So differential amount we will subtract. Net amount is what directly we apply it on spot market. Okay. Now, one more beautiful thing about commodity market. Commodity market means it is not only about interest and dividend. You also have to pay some money for storage purpose. Go down fees, rent, that also will be added. So if it is for a commodity like gold, you have to maintain security and all required. So you're also going to add rent, cost of carry. You say rent, spot market price plus rent plus interest minus dividend will be for a commodity market. That rent we don't do for shares because the demand charges are hardly negligible, so we ignore it. But in case of commodities, storage cost is a very essential element. The dividend is called as convenience yield. Okay, now fair value should be equal to price. Now, if equal, this is equal. If equal, no arbitrage exists. That means fair value is equal to market price. But if not equal, so we'll discuss in two situations. That is, if fair value is, you can just say that fair value equals to future price. That means no arbitrage. No arbitrage. But if two situations you can think, fair value is greater than price, future price, or let's say price, I'll think from price point of view. If price is more than fair value, or other situation, if the actual price is less than fair value, FV means fair value, okay, I use the shortcut. Now, when these two are not equal, the market is not fairly priced. The market is not giving me risk-free interest. This interest should be risk-free interest. This interest should be risk-free interest. So future value should be spot price plus risk-free interest. Same for everybody. Then the future is fairly priced. If the future is not fairly priced, if the future is not fairly priced, then there exists arbitrage opportunity. I would like to talk one or two more points regarding this fair value quickly. See if you can think logically. Now, future price should always be more than spot price, sir. Why should always be more than spot price? Because of time value of money, interest. But if there is dividend expected, in those cases, future price can go down. Now, second most important point, on expiry dates, spot price and future price will coincide. Very important point, on expiry dates. On your expiry also, your dream, your future, your spot becomes same. Why? Because what is spot price? Settlement on same day. What is future price? Settlement on expiry date. When expiry date is same day, they're going to be settled ultimately on same time. That means no time value of money, no time gap left. So on expiry, spot price and future price will coincide. Or you can understand, as the time progress, the gap between spot price and future price keeps coming down because of interest. Interest represents time value of money. As the time reduces, you're approaching expiry, the gap reduces. On the date of expiry, spot price, future price, both will become same price. Very important point. If you want to write somewhere, on expiry date, spot price, future price will coincide. And this interest always represents time value of money. And time value of money means what? Date of transaction and remaining time to expiry. The interest should always represent residual time, remaining time to expiry. Residual time. If I entered 10 days back to the expiry, 10 days interest. If 2 days over, remaining are 8 days, 8 days interest. That should represent time value of money. So that is regarding the fair value calculation. In the exam, problems I've seen are only compute the fair value of futures. I've seen such kind of problems as well. Basics are this. Okay, now two situations exist. Price more than fair value. Then what transaction exists? Price lesser than fair value. What transaction exists? Let me tell you. Now, price is more than fair value means what? It is overpriced. It is overpriced. Now, overpriced where? Price is more, future price is more, price is more in future market. So, if I write it as three types of market for your reference, one is future market, one is spot market, other is uh, money market. Because in long position, short position, we had discussed. If you want to buy in future market, only margin money required. If no margin money, free investment. In future market, only margin. Otherwise, you ignore it. But in spot market, if you want to buy, you need paisa. You need to borrow. So I called as money market. Okay. Now, and again, I am going to have two columns today on expiry dates, or let's say later. Later, I will not fill it up now. So I'll just keep it for your reference. Similarly, here also, I'm going to follow same situation. If price is lesser, what I'm going to do? I'll come to it little later. Just focus. We are just trying to get the theoretical part. So conceptually get it right. Later when you do problems, this should act like a summary for you. This should act like a one-page summary where every chapter or all concept relating to future you should find in this page. That's the kind of chart I'm trying to build. So overpriced. Overpriced means what should I do? If something is overpriced, is it good to sell? Is it good to buy? When something is high price, why should I go and buy? It's high price, it's costly. Overpriced means I should sell. So in the future, I should sell. In the future segment, okay, not in the future. In the segment, I'm going to sell. In the future segment, I'm going to sell. In the spot market, I should do opposite. Whatever I do in the future market, opposite I do in the spot market. So in spot market, I'm going to buy. That's a simple concept. Please keep it in mind. If it is overpriced, you are going to sell. Underpriced, you are going to buy. And in the future market, if you sell, in the spot market, you do buy. In the future market, if you buy, in the spot market, you do sell. Opposite in nature. Because the price is overpriced, the price means future price. So future market is overpriced. Sir, arbitrage is a comparison between two markets. Here, what are the two markets we have? Spot market, future market. Future market, future price. Spot market, fair value. To market disparity, arbitrage, NSE, BSE. If it is not equal, buy in one market, sell in another market. Buy at a cheaper market, sell at a higher market. Now in this case, future is overpriced, so you should sell in future, future segment, and in the spot, you have to buy. Two markets, spot market, future market. So in spot market you buy, in the future market you sell. That is, in future market, I can tell you, you are taking a short position. Correct? You are selling today. That means you are taking a short position. In spot market, you are taking a long position. Now, if you want to buy the shares, you need money. Therefore, in money market, I am going to do borrow. I'm going to borrow. And later date, I can do settlement by delivery basis where future will be squared off, spot will be squared off, money borrowed will be repaid. Or I can do settlement by delivery basis. Means what? I've entered into future sale agreement. I execute it at whatever price. Thereby, I get arbitrage profit, fixed profit, riskless profit. Maybe I can show you one quick example a little bit later. I'll just complete this table, then I'll show you example how arbitrage profit or loss can be achieved. Now, easy to remember also, my dear friends. Look at these terms: F, S, F, rearranged SFM, spot market, future market, money market. Okay. Now, try to think in second situation. Can you imagine what to do if it is underpriced? What should we do? If it is underpriced, what should be done? When price is less than fair value, means future is underpriced. Something underpriced, it's cheap, I will buy. So in future market, I'm going to buy futures. I will enter into buy future. I'm not paying any amount. That means in here I'll take a long position. I'm buying in future means where will I sell? I will sell in spot market. That is, in spot market I'm going to take a short position, and once I sell the shares, I get the money. So money I'm going to deposit. So this is the process of arbitrage if it is underpriced or if it is overpriced. Again, these are the transaction today. A transaction later will be just the consequence. Can be settled by net basis or can be settled by delivery basis. Ultimately, both profit or loss will be same, and more importantly, here that profit or loss will be known in advance. I'll quickly give a numerical example. You understand. But before that, if you have any doubts in this structural discussion, please get clarified. I'll give a quick numerical illustration before I go to hedging. Okay. Let me give a quick numerical example to make you understand this hedging process. Okay. Suppose spot price of a share is 1000 rupees, and let's say rate of interest is 12% per annum, and time to expiry, let's say 3 months. Time to expiry 3 months. And presently, future currently trading at future price currently trading at, let's say, rupees 1050 rupees. Okay, so what is the first thing I should do? Before I execute a strategy, I should identify whether it is overpriced or underpriced. So I have to compute future price and fair value. Future price I know it is 1050, means this is for future market. Future price, this is for future market. Then I look at spot market. Spot market means fair value. Fair value, that is spot price plus interest. Spot price thousands, interest, I'll take simple interest for the time being, 1000 into 12% for a period of 3 months, 3 by 12. So I think you get 1030, 1000 plus 30, 1030. So this will be for spot market. Now these two are not equal, 1050 here, 1030 here, so not equal. That means there is an opportunity. Arbitrage opportunity exist. Arbitrage opportunity exists. And how do you construct the arbitrage opportunity? I'm going to tell you now. Now look at that. Future market 1050 is greater than spot market at its fair value 1030. Something is greater. So we say the future is overpriced. And overpriced means the future market I am going to sell and spot market I am going to buy. Future is overpriced. That is why it is going to be sold. And when this and one is sold, other is buy. So one market I sell, other market I buy. Hope it is fine. Now, how actual transaction takes place? Series of transaction or whatever arbitrage process. So you can explain by settlement by delivery basis, or you can explain settlement by net basis. In the exam, you can do both. If nothing is mentioned, delivery is easy. I'll explain both. Settlement by delivery basis. I mean, that difference will happen only later point in time. Okay, let me write it. So you do some transactions today. Transactions today and some transactions on expiry, which is what? Later date. That is 3 months later. Because in this case, expiry is 3 months later. 3 months later. And only here the settlement by delivery basis or net basis matters. Transaction today will remain same. But anyway, so let me tell you here, settlement by delivery basis. I told you 3 markets will be there. That is, in future market, what do we do? In spot market, what do we do? In money market, what do we do? In future market, I told you we are going to sell, right? That's what I've written. Sell or future sell. Enter into future sell. Enter into future sell. At what price? At the price prevailing 1050. Now in future I'm selling means spot market I will buy. Why I'm writing enter into? Because it's a contract. I'm not receiving 1050. I'm not selling the share today. It's an agreement. So that's why I use the word enter into. Spot market, yes, opposite you have to buy. Buy the share at rupees. In the spot market it is 1000. And where do you get the money? If you want to buy the share, so you have to borrow. You have to borrow rupees 1000. Okay. Now this is today. Now transaction later. Now settlement by delivery basis. Means what? This contract what you enter into will be executed. Settlement by net basis means this contract will be cancelled. Now, if it is settlement by delivery basis, this contract will be executed. Executed. Means what? You sell the share at rupees 1050. Where is the share for you to sell? You purchased right earlier. Buy the share. That is what is going to be sold. And thereby, you will make a profit of 1000 you bought, 1050 you sell. So you make a profit of 50 rupees. And you borrowed 1000 rupees. On that you have to pay interest. So repay. along with interest. How much? 1000 plus on 1000, 12% for 3 months. That means 1000 plus 30. So you're going to repay 1030. Now, 1000 you borrowed, 1030 you are paying. So what is the cost? Interest cost. Interest cost is 30 rupees. And what is your net profit? Net amount, net profit, that is 20 rupees. That is what is arbitrage profit. Arbitrage profit. And why it's called as arbitrage profit, riskless profit, certain profit? Why it is called as? Because you see, we are not at all looking at on transaction date, on expiry date, what is the market price. Not relevant for us. You have entered into an agreement earlier, you execute it now. For us, that agreement matters. Market price does not matter. So whether market price goes up or comes down, we are executing our agreement. So market price has no relevance. Our profit is guaranteed. In fact, what is this profit if you observe carefully? What is the fair future price? 1050. And what is the fair value? 1030. So what was the difference? 20 rupees, for which we told arbitrage opportunity exists. And you see, exact 20 rupees we could achieve by executing this transaction. The same thing I'm going to show it to you. Settlement by net basis, how the thing would change. Operations only will change. Overall profit will not change. I'm going to show it to you. First you take it down and let me know if you have any doubt. Okay, I hope you have taken it down. I'll take this part out. Settlement by delivery basis. Now I'm going to do settlement by net basis, square of basis. Okay, settlement by net basis or square of basis. Now here, even the market price is going to play a role here. Settlement by net basis. Settlement by net basis means square of. So in this situation, what will I do? The future segment what I have, spot segment what I will have, I will not mix it. Future segment, I'll do separate transaction. Spot segment, I'll do separate transaction. And ultimately, I'll prove overall profit will come to the same number. So for me to settle the future price, I need the future price. For me to settle the spot price, I need the spot price. I'm not mixing the two segments. I'm keeping the two segments separate. So on expiry, what is the future price? On expiry, what is the spot price? So on expiry, what will be the price? Sir, 1000 rupee. No, this is spot price today. Sir, 1050. No, this is the future price today. These are all today prices. Today's spot price in spot price in price in the today price in spot segment. 1050 is today price in future segment. Both are traded today. But on expiry, how much it is, we don't know. But the beauty of arbitrage is how much ever may be the amount, we should get the same answer. So let me assume if market price is 900, and I'll assume if market price is 1000, or let's say I'll assume if market price is 1200. Market price falls to 900 is one situation I will discuss. Market price increases to 1200, another situations I will discuss. And the best part is, in both scenarios, I am trying to prove I will get the same number. Why? Because I took one lower number, one higher number. Just to prove, any number you take, our profit will remain same. It should remain same in arbitrage. Riskless profit, certain profit. And one more hint, in the exam, if they give you like this, in the exam, if they give you compute the arbitrage profit, if on expiry date price is 900 or 10,200. So if they give price on expiry, it means in the exam you have to solve by net basis, square of basis. If they're not given like this, you can choose either delivery basis or net basis. But net basis, if they're not given, you have to assume a lower number and assume a higher number. Now this 900 or 1200, is it future price or spot price? This is the price prevailing after 3 months. For which market? For future market applicable or for spot market applicable? The answer is both. How? Because I just told you earlier, on expiry date, spot market and future market will coincide. Because on spot market, it is the same day settlement. On future market also, no future left. That is the future. So on that day only, you will have the settlement in future as well. So the settlement dates are same. The prices will coincide on the expiry date. So this 900 is spot price and the future price on expiry date, because both spot price and future price will coincide. Okay, now at 900 rupees, I mean at 1050, you have entered into future sell. Now what you are going to do? You will do future by square of future by square of future by at 900. So what do you get? You get profit, right? You sold at 1050, you bought at 900. So difference, you will have a profit of 150 rupees. 1050 you sold, 900 you bought. So you have a profit of 150. Or you can also tell you have taken a short position. Sell means short position, and you are buying at 900, you make a profit. Okay, then what you are going to do here, future buy the share at 1000. I mean, earlier you bought the share 1000 spot market, now you are going to sell it. You are not mixing the segments. Future segment separate, spot market segment. So you are going to sell it at today's price 900, and you will have a loss of 1000 rupee you bought, 900 rupee you are selling. Therefore, you will have a loss of 100 rupees. You bought earlier a long position, now the market fell. In long position, falling means loss. So loss of 100 rupees. And you borrowed earlier, so you are going to repay now along with interest. We already calculated. So that is 1030, right? Along we already calculated. Repay 1030. So you will have an interest cost of 30 rupees. So what will be your overall profit? 150 rupees profit, 100 rupee loss, 30 rupee interest cost. So 150 minus 100 minus 30, you will get overall profit of 20, and that is what is your arbitrage profit. And if I follow, if market price is 1200, okay, if market price is increasing, what will happen to my position? Let us discuss. Market price increasing to 1200. So, same future sell earlier. Now I'll do square of future buy at what? 1200. Future buy at 1200. So, what will happen to your position? Will you get a profit or loss? You sold at 1050. You're buying at 1200, buying at a higher price. You have taken short position. Market price increased. So you are going to incur loss of 1050 to 1200, meaning you will have loss of 150 rupees. What will happen in spot market? You bought it at 1000. Now you are going to sell at 1200. You're selling at higher price, you will make a profit. How much profit? You will have a profit of 200. You have taken long position in spot market price increase, that is profit of 200. And as usual, here also you will pay same interest cost of 30 rupees. Interest cost of 30 rupees. You are going to repay the borrowing along with interest 1030. So your interest cost 30. So loss of 150, profit of 200, interest cost of 30. So overall you will have a profit of 20 rupees. Same arbitrage profit, same overall profit. The cash on hand. That's the beauty of arbitrage. If the fair value and price is not equal, the difference between the two, underpriced, overpriced, is our arbitrage profit. The difference between the fair value and future price. Riskless profit, certain profit, arbitrage opportunity. And how do you execute that? What is the arbitrage process? You can you can prove with the help of settlement by delivery basis or with the help of expiry basis. Both will give the same answer. And if you are proving with settlement by net basis, then means square of basis, net basis, you need to do under two scenarios. If market price increase, how will get it? Market price decrease, how you will get it? You get the same amount, but the process of transactions will be different. So please write it down, and if you have any doubts, let me know. This is what one situation, underpriced. I mean, this is what overpriced. Similar things will apply for underpriced. So this is the futures. We have done with the speculation. We are done with the arbitrage. After this, very important concept from exam point of view. Almost every two attempts one they will ask. That is hedging. Hope you are done till here. Okay, very good. Okay, so after speculation and arbitrage, now we are moving towards the next one, which is uh, hedging. From exam point of view, it is definitely very important. At least 2 attempts once this area is being tested. So what is hedging? Essentially, hedging is risk management tool or risk management process. Risk management process. So you can use it for increasing the risk, avoiding the risk, or minimizing the risk. So you can see hedging can be used for uh, reducing the risk or avoiding the risk, avoid risk, minimize risk, or even you can increase risk. You can even increase risk, but avoiding risk is theoretical in nature, may not be practical, but it's called as perfect hedging. Perfect hedging. So if they tell you perfect hedging, that means I am making zero risk. Of course, it's not practical, but theoretically, at least we will discuss. Okay, I'll write in a separate slide, hedging piece. I don't have enough space here. I'll write separately. Okay, now hedging. Try to understand the process. Hedging means I would like to cover risk. Which risk I'm trying to cover? I have a portfolio. I have investment in portfolio. I have invested in equity shares. I have invested in Infosys, Reliance, HDFC Bank, Asian Paints, Power Grid, HAL. I have a portfolio of shares. Now this portfolio, I'm worried about the share price falling down. So what do I do? Against the portfolio, I will take opposite position. That's what is called as hedging. I'll say in general, have a backup before breakup. The process of covering your risk. So in portfolio, you have an issue. In portfolio, you have a risk. In portfolio, you have taken a long position. Now, to compensate that long position, I take a short position in the corresponding future instrument. And that to what future? I will select index futures. Why index? It's a market portfolio. It has good liquidity in the market. And why index future? Because I cannot buy index. I cannot sell index, right? So buying and selling index is not easy. And that too in short position in spot market is definitely not easy. Therefore, on portfolio of shares, you take a long position, and in index futures, why index future? Because index is a portfolio. Why future? Because index spot you cannot do it. And more importantly, more than stock future, index future will have a good volume, good liquidity in the market. If you want to sell, somebody should buy it. So volume should be there, liquidity should be there. That is possible in index future. So here we are going to take a short position. I'm going to take a short position. And one more thing is can I say amount should be equal? Amount of portfolio of share will be equal to amount of index future? No, that is not true. Why is that? Because the risk is not equal. How do you measure risk? Risk is measured through the movement of security, movement of portfolio compared with the markets. Movement of portfolio compared with the market is measured through what? Beta. So for portfolio of shares, I will multiply it by beta. For index future, I'll multiply it by market beta. And what is market beta? Market beta equals to 1, right? Therefore, you are having three situations, I'll say. If you want to do perfect hedging, or if you want to do partial hedging, partial coverage, minimize the risk, partial hedging, or you want to increase the risk. I don't say hedging there, so I'll just say if you want to increase the risk. What should be your positional amount? position in index futures. Position in index futures. Perfect hedging means you are trying to achieve portfolio beta equal to 0. You want to achieve portfolio beta equal to 0. Partial hedging means you are trying to reduce portfolio beta from the existing. Increasing the risk means you are trying to increase portfolio beta. And how do we calculate perfect hedging? Portfolio amounts multiplied by portfolio amounts multiplied by beta. In fact, I will tell specifically it is 0 minus beta. I mean 0 minus portfolio beta, because 0 is my target portfolio, beta of the portfolio is existing. From the existing, I want to reach 0. So this is going to be short position. Negative number comes, so negative means I am going to take short position. This much portfolio amount into beta, I am going to short it. Whereas if you want to reduce the beta, what you should do? For that purpose, let me explain this one. Some people are confused. Sir, how to decrease beta, how to increase beta? I'm a little bit confused. I'll give a very simple format. Please take a look at this. First standard student can understand this number. Current portfolio beta, target portfolio beta. We have one current risk and we have one target risk. The difference is what? How you achieve the difference? By taking position in index futures. By taking position in index futures. Okay, now I'll give you a numerical example, don't worry. So we are in suppose current beta is 1.7. Current beta is 1.7. Let me tell you plus 1.7. I want to reach target beta of 0. If plus 1.7 should become 0, what should I do? How 1.7 becomes 0? I should do minus 1.7, right? Plus 1.7 minus 1.7 becomes 0. This minus what? It means you should do short. So if I take long position in portfolio, I take short position in index future so that over becomes 0. Suppose if it is plus 1.7, I want to reach 1.5. From 1.7, I have to come to plus 1.5. So what should I do in index future? Can you tell me? If 1.7 should become 1.5 means I'll do what? Minus 0.2 in index futures. Simple mathematics. So if you are having plus 1.7 long position in index future, I mean in portfolio, minus 0.2, minus means short it in index future, thereby you can do plus 1.5. You can increase also. Just imagine plus 1.7 you want to reach 1.9. So from 1.7, if you have to go to 1.9, you want to increase the risk. That means you are going to do plus 0.2. Plus means long position. You are already having some long position. You take some more long position, thereby you increase the risk. See, long plus short net will reduce, but long position, again long position plus risk will increase. Take this table somewhere. Just take it to your head. The current beta, the target beta, how I achieve my target is by taking position in index future. The target is achieved by taking position in index futures. So take down this table quickly, then I'll go back to the previous slide and fill up the data points. I'll give a numerical also, don't worry. So you can remember plus means long, easy to remember. Minus means short. That is for our reference, okay, not outside the world. For our reference, plus means long, minus means short. Okay, hope you understood. I'll go back. So in fact, I don't have to do 0 minus beta. I just say portfolio amount into beta. I have to do short. Concept you understand. Why I'm telling short? Numerically for you to remember, plus means long, minus means short. Conceptually what I'm telling, in portfolio I take long position, so in index future I take short position, opposites. You understand, right? If I have an asset, I create a liability. Thereby, they will set off each other. If I have an asset in foreign currency, I create a liability in foreign currency so that the movement will be set off with each other. One up, one down. That is why. I'll explain. With the numerical, I'll explain. Okay. So, portfolio amount into beta is what? The position amount in index future, amount wise. Partial hedging means portfolio amounts into what I would like to achieve, target beta minus current beta. Target beta minus current beta. And target beta minus current beta I'm doing. Why? Because if it's easy for me to tell. If the answer comes plus, you take long position. If answer comes minus, you take short position. Is what I follow the method. But in some textbook in the material, you might see current beta minus target beta. So target minus current, current minus target, that you don't get confused. Just understand how you achieve the difference is in index futures. What process I follow so that long short confusion will not be there. Target beta minus current beta. You can see here also I did 0 minus beta portfolio. 0 is target, 0. Because perfect hedging means we would like to make portfolio beta is 0. No risk. That is fine. So minus means short, plus means long. It is easy to apply. That's why I follow this format. So if the question in the, some textbook might say current beta minus target beta, don't get confused. So partial hedging. So if negative, this here usually you get negative number because target will be low, no. So you get negative number. Therefore, you will have to short. But when I follow the same process, okay, same formula for increasing the risk. But in that case, target will by beta will be high, higher risk, higher beta. So I'll get a positive number. So when I get a positive number, this means I have to do long. Okay, then this is position index future amount wise. But you know, exact amount I cannot enter into future because of lot size constraint. So for that, you might be aware of the number of contracts. Number of contracts. The same formula, that is portfolio amounts into beta or 0 minus beta you can say, divided by value of one contract because lot size will be there. For that I will do lot size, like Nifty lot size was 75 earlier, now 50. Bank Nifty is 25. Anyway, lot size into index future price. Index future price, not value. If value is not given, I mean, if price is not given, then I'll say value and price both are same. But if given, you should take index future price, lot size. So this denominator represents value of one contract. Same way, okay. And here, if I am using for these two, what will be doing? Portfolio amount into differential beta, target beta minus current beta divided by lot size into index future price. So the same format I'll do here also, okay. Denominator, numerator I would explain. So if it is position index future amount wise, you multiply beta. But if you want number of contracts, which is practical scenario, you should divide by lot size into index future price. And this is also one of the reason perfect hedging cannot be achieved. Why? Because number of contracts may be decimals. Round off required. So when you do round off, either you cover more or you cover less. So for which perfect hedging may not be achieved. I'll show numerical, you understand. Even for partial hedging and even for increasing the risk, the numerator is portfolio beta into differential beta, target minus current, but denominator will be same, lot size into index future price. Okay, now let me give a quick numerical to understand this, how it works. Okay, suppose current portfolio is 10 lakhs. Let's say beta of portfolio is 2 and lot size, let's say 50, index future price, let's say 1000, 10,000. Okay, this is the situation now. What format we are going to follow? Very simple format, observe. What is the position today and what is the position later? Let's say if market price, I mean index market is up by, or let's say I'll just talk about down, it's down by, let's say 5%. You can also think about if index up by 5%. Let me just first talk about this. Index down by 5%. Now, if index down by 5%, what will happen to your portfolio? Applying beta. What is this beta means? If the market is changing by 1%, your portfolio is likely to change by 2%. So if index is down by 5%, so your portfolio will be down by beta times from the market to come to security, from the market to come to portfolio. We have to apply beta. So 5 into 2, that is, it will be down by 10%. So keeping this data in mind, let's decide what is happening to your position in spot market, that is portfolio, and what is happening to future market, that is in index futures. Now spot market, you are having current portfolio of 10 lakh. So portfolio amount 10 lakh. And this you are in general, nothing is specified. You are investing for a future period. Your purchase today, that is implied. So long position implied. In index future, you have to enter into number of contracts. And what is the formula for number of contracts? Portfolio amount 10 lakhs into beta. You can do 0 minus beta also. I'll just do beta into 2. If I do 0 minus 2, I get minus 2. Minus means short. That's why I tell 0 minus beta. But anyway, 10 lakh into beta divided by lot size 50 into index future price 10,000. So how many contracts I'll get? 10 lakh into 2 by 50 by 10,000. So I'll have to enter into 4 contracts. 4 contracts. And what do you mean by 4 contracts? Just try to interpret. What is the value of one contract? 50 size into index future price 10,000. So value of one contract, one index contract, 50 units into 10,000 each, which is 5 lakh. Which is a 5 lakh. And you are entering into 4 contracts. So what is the value of contract? Total value, value of position, for positional amount, 4 contracts multiplied by 5 lakh each, 20 lakh. What is the 20 lakh? Are you able to get it from the basics? That is what? Portfolio amount into beta, right? What is portfolio amount? 10 lakh into beta 2. 10 lakh into 2, 20 lakh. Hope you are able to understand. One more way of explanation. In portfolio, you are investing 10 lakh. Index future, you're investing 20 lakh. Why are you investing more in index future? Because portfolio is double riskier. You understand? Portfolio is 10 lakh, index future 10 lakh, amount may be equal, but their risk is not equal. Why? The portfolio is more riskier. If portfolio is more riskier, index future also, I should increase such a way that the risk can be balanced, for which purpose I multiplied by beta. Hope you understood the logic. Okay, now index down by 5%, portfolio down by 10%. So what is the portfolio change? Portfolio down. In long position, portfolio down means loss. So loss 10 lakh down by 10%, which is 1 lakh. In index future, what is happening? Remember, here you have taken a short position. You should take a short. Why? Long in portfolio, short in index. Another way of understanding, I told you it is 0 minus 2. In the formula I told you. So minus means short. You should take opposite position to offset the movements. Now, in short position, index down by 5%. Do you think you make profit or loss? In short position, you will make profits. You will make profit down by 5%. How? You can do directly 20 lakh into 5%, or I can do in detail 4 contracts, each contract containing 50 units, each unit is worth 10,000. I know directly you can do 20 lakh in this number only will get, but I would recommend you write it separately. Why? Because in some other problem, round off issue may be there. That's why follow this process. Number of contracts, 4. Each contract containing 50 units, and each unit is worth 10,000, multiplied by, it is changed by 5%. And it's going to be profit because short position, price falling is profit, which is 1 lakh. So what is overall position now? Overall position, overall profit is 0. Market is down by 5%, portfolio down by 10%, but after the position, our portfolio actually is foolproof, is risk proof, it is not at all changing. But I mean, this is what is called as perfect hedging. Even though market is down, overall your portfolio is unaffected. Perfect hedging. This perfect hedging has got some practical limitations. What practical limitations? First point, number of contract we got exactly 4. If it is 4.2, you should round off to either 4 or 5. 3.9, we should round off to 4. So if it was round off number, decimal number, we would not have got an exact profit or loss. And second more important thing, keep it in mind. Second most important thing, when index is down by 5%, I multiplied by beta, portfolio down by 10%. This may not happen on a daily basis. Beta is just a historical statistical measure. On an average, it happened like this. So every day, if index is down, portfolio will not be down by 10%. It can be down by 4% also. It can be up by 1% also in some days. Meaning the actual return and calculate based on beta happen to be equal. Therefore, perfect hedging could be achieved. But in the exam, if they tell you specifically portfolio down by 6%, then you will see the overall profit will not be exactly zero. It will be some plus or minus. And also, some people argue like this: why should I do perfect hedging if my overall position is zero? If I want zero profit, zero loss, I'll not go to stock market. I will sleep at home easily. I will not come to this class. I'll aram se take rest outside. Why should I come to this class and listen to this boring lectures, torture? No. See, even in business, we learn something called as break-even point. Break-even point means where profit or loss is zero, cost equal to sales. Now, does that mean if profit is zero, why should I do business? No, it is the benchmark. If you want to think, or that is the level you have to cross to be profitable, like that, this is the situation. Perfect hedging theoretically. Whether you want to do it or not, that's left to you. Sir, why will anybody do it? On some days you might do it. Some situations you might do it. For example, in last 1 year, stock market has increased, you are at a good profit. Now, the cases are increasing or this Omicron virus is coming. Now, people are worried. What if market falls? I want to have a zero profit for next 1 month. It's okay. I made good profit. Next 1 month, even zero profit is okay for me, but I don't want my portfolio to go down. I want to protect from downfall. I can do perfect hedging. Of course, if things go as per expectations. So in different situations, it may be applied. So don't think that zero loss means why should I come to stock market? Okay, just understand the process here. So here I multiplied by beta as directly as 2. If I want to go from 2 to let's say 0.5, I want to reduce my risk. Then how much position I will take? This will multiply by 1.5. 1.5 short. Correct? So difference between target beta and current beta, what I would like to achieve, the difference that I take the position in index futures. Okay, so take down this example. Let me know if you have any doubt. So this is actually summary of the entire concept relating to futures. I'll go back to the previous chart once more. Hope you have taken it down here. Okay, I'll go back. Okay, so now try to bring everything into one place. Futures or forwards are contract entered today for a settlement at a later date. The date is called as expiry date. Futures are standardized instrument in the market, so they have got some special features. Standard expiry date like monthly expiry, lot size, it has to be in those multiples. MTM, mark to market settlement. We have early settlement. We have a square of positions. These are the special features of futures. Now these instruments can be used for speculation, can be used for arbitrage, can be used for hedging purpose. Speculation means our profit or loss is uncertain. So based on my view, I take a long position or short position. If my view goes right, I make profit. Otherwise, I make loss. That is speculation. Arbitrage means I compare two markets, spot market, future market. Now, spot market means spot market plus interest, time value of money, minus dividend, fair value of market. And so, fair value of future. So, these two market price should be equal. If equal, there is no arbitrage opportunity. If not, there is arbitrage opportunity, whether overpriced or underpriced. Overpriced means sold, sell in future, underpriced means buy. And whatever you do, opposite in you do in spot. In future, if you sell, in spot you buy. And if you buy in spot, that money you will get it from money market, you will borrow. And this can be proved either by settlement on delivery basis or settlement on net basis, square off basis. Settlement on delivery basis means whatever the agreement you executed, whatever the agreement you entered will be executed and the profit will come to you, which is exactly the difference between fair value and future price. If it is settlement by net basis, you have to assume two numbers if not given in the question, one higher price, one lower price, and those prices are spot price as well as future price, because those prices on expiry will be same as spot price and future price. On expiry date, spot price and future price will coincide. And again, this difference, whatever arbitrage profit you get, will be exactly same as what you get in settlement by delivery basis, will exactly be equal to difference between fair value and future market price. And next we have, arbitrage, it's a known profit. So speculation, profit may be loss or profit. In arbitrage, you will have a known profit, riskless profit, certain profit by the transaction we carry out. In hedging is the process of reducing the risk or minimizing the risk. We have perfect hedging, we have partial hedging, we can increase the risk. And how we achieve perfect hedging? By taking a position in index future equal to portfolio amount into beta divided by lot size into index future price. This is called as perfect hedging. In the numerator, if I take the difference between current beta, target beta, that will be called as partial hedging. And if I am increasing the beta, that is increasing the risk. And when I take long position in portfolio, I take short in index futures. And if I take the exact beta amount, I get perfect hedging. And perfect hedging is achieved under two assumptions. Number of contract is round off and beta holding good. That is index movement multiplied by beta is a portfolio movement. If index does not hold good, portfolio moves differently, or number of contracts is not exact number. If it has round off, if it has decimals, then perfect hedging may not be achieved. Perfect hedging means basically beta equals 0. Minimizing the risk, partial hedging, current beta minus target beta, differential amount. And increasing the risk means we take extra position in index futures. So this is the whole summary of futures in one chart for you. I hope this chart will be useful for you when you do revision or when you do any subsequent problems. Okay, good.